Welcome back to Golden Rule Radio, your weekly recap of the precious metals. What a week it has been. What a week it's shaping up to be. And Miles, arguably the most pivotal show I think we've done in our history here with this recent price action.
Well, certainly since we started the show a couple years ago, other than maybe the big gold breakout, when we looked at gold finally jumping above those 1350, 1400 numbers, we're probably looking at one of the more important weeks in metals history. And we said that last week. Robert, I know, talked about the S&P and the Dow and breakout potential there.
And the dollar.
The way it's all tied together, this is a pretty impressive show. I know everybody's going to be looking for that show when we say, hey, gold's 2,000, because that's a big psychological number that we all want to hit. But from my perspective, the way the charts are moving and what's going on and how all these markets are tied in together, I agree with you. I think this is a penultimate point in market movements here over the next couple years.
Yeah, just for reference, from last week, like close of markets Friday to where we are today, that's about a 4% jump in gold. But the key is that we're only about 2.85% from the all-time high. Remember, back in 2011, we hit 1,925 and change. And here we sit at 1,872 as of this recording today on Wednesday afternoon. So just a couple few points away from the all-time high. And that, too, will be a psychological number that's going to garner a lot of headlines. And when that happens, you're going to see it likely, I'm going to put you on the spot here, little resistance point there. Do you shoot right up to that 2,000 because of the headline grabbing new high in gold?
Realistically, the likelihood that you've got like 10-year-old standing sell orders sitting at 19 and a quarter is zero. I mean, nobody's had cash tied up in an unfilled order for 10 years. So unless there's new sell order, either profit taking or at this point, there are no bears. So it's not like there's anybody out there looking to short this market.
Great point.
It's really just who wants to take profit at the old highs. What percentage of people are willing to take profit, sell their positions out, which will supply demand push the price back down. But long-term standing orders, can't imagine there are any. I certainly wouldn't just tie my money up in an unfilled order for 10 years, and I don't know many traders who would. And clearly nobody's on the side of the bear at this point. So I do want to point out, for me, the reason why this week is so paramount specifically in gold, and we haven't even gotten to where the real movement has taken place, like silver and the US dollar.
Can't wait to get there, yeah.
But for me, what's paramount is the fact that we are now into the week of September 5th, 2011 pricing. That was the week where we had the big $100 rise in a single week to put in that all-time high. So we have now scraped the bottom of that candle from the week of September 5th. So for all intents and purposes, we're right there.
Okay.
We may be $100 away, but it's $100 that happened in a single week.
Yeah. So from a tech standpoint, we're entering into a channel in a sense, but I loved your chart of last week. I know that we were not able to definitively say, yes, we're at these resistance points, we're going to break above or it's going to bounce back down. We did break above, but you had a beautiful chart there where 1925 is an assumption. We were sort of needing to break above the past high ceiling built in 2012, and we just did that 1835-ish mark or whatever else.
Right, those 3 times we tried to push back up to the old high.
Yeah, and then, the next chart you put up is, look, from there, it's really going to go relatively unchecked to that previous high. Maybe we meet a little resistance at the round number of 1900, like you're saying. Maybe there's some profit points put in, on these trading platforms. But really exciting, and like you said, it's nothing compared to silver. But why don't you round out these charts for us and kind of break it down?
Sure. So coming into the bottom end of that last candle from 2011 when we put the high on. Now, I like bottoms of candles. It's just a personal preference of mine. That may not make sense to anybody else, but from a turning point in a market, I like to enter on the low end, right? I like to be conservative with my entry or exit points. So as we've done that today on Wednesday, you certainly could be looking and saying we have now tested the high for the first time. This is a test of the old high. We have massive divergence against RSI that can argue to push the price down. We have been calling for a correction for a while now, since the March drop and since we broke back above that. through April and May, and really for the last month, gold was on borrowed time for this price push up. It is due some semblance of profit taking from people who may have got into the ETFs at 13, 14, 1500. They're seeing substantial price gains over the last 2 years. Why not take a profit at the old highs? So it's very likely we could see some semblance of a pullback in gold. I would like it to happen sooner than later. I was talking to a client of mine about this yesterday. The higher the price gets, just like the giant, the bigger they are, the harder they fall. A $250 drop in the price of gold tomorrow is nothing. And that's going to scare a lot of people. It's easy for me, who stares at this stuff all day long, to say who cares, but most people won't. You see gold drop $250 tomorrow. That's a healthy, fairly minor Fibonacci correction. But on CNN or any of the major news media sources that are looking at the markets, they're going to tout that as one of the biggest drops in gold's history, because it would be. So be prepared for the volatility. I know a lot of our listeners are already investors, and at this point, what we're looking for is the next opportunity, whether it's a ratio trade down the road, whether it's an entry of another position. Just be aware that that is still an option, and get ready for some volatile markets, whether we turn here or whether we go up another $300 and then have an even bigger fall. We're working with our clients to find those ratio trade opportunities when the price pushes to higher levels, or if we get a pullback, helping our clients find those entry points to add to their pre-existing positions.
Yeah, speaking of the ratio, Miles, before you move on to silver, which is responsible for this ratio correction, in the last few weeks, we've seen just a very aggressive contraction in that gold to silver ratio. And here we are in the high 80 to 1, just right around 81 to 1, really, in the gold to silver price. And that's remarkable performance. And you're about to show us why. Like, what's contracted that ratio down so tightly?
Well, obviously, it's silver doing the same thing that gold did a couple years ago. We finally had that higher high in silver we've been talking about, pushing silver up to some price levels that we haven't seen since 2013. We've been talking about silver lagging behind gold for quite a while, because here I've got a chart where I've got gold and silver overlaid. So you can see how they followed pattern until gold finally had its breakout above its 2013 levels last year. Well, and silver, of course, didn't. Silver continued to lag. Silver continued to put in lower lows. And this is one of the big fundamental arguments that we've been putting out for the last year, why we're so bullish on silver. It's because this has happened before. This happened back in 2008. You had the gold breakout. Silver lagged behind. When silver finally decided to play catch up, it was too late. You couldn't possibly catch that moving object. So if you look at these two charts together, we had the gold breakout above those 2013 levels at the beginning of 2019, and we all know what's happened since. I mean, gold has gone from 1,400 to now over 1850, 1875. Silver has just done that today. We are now scraping against those 2013 highs, and it's very likely that ratio, which extended all the way up to 125 to 1, immediately went back to 90, now is down to 80. When it's 40...
Now we're talking.
Exactly.
And this 80, you got to remember, I mean, we were there for a long time, right? We were in the high 70s to mid 80s for many, many, many months. So we've come back down into the range where we saw the ratio before. We just got a bonus ratio play by jumping up to the 120s and coming back down here. So that's all fine and good, but this silver performance is incredible. I talked about gold being up 3.5% from last Friday. Try silver's 18%. And not only that, but silver's up over 85% from the March bottom that we put in this year, March bottom. And yet we're still 54% away from its all-time high. So 2.85% away from the gold all-time high. We're still 54% away. So that's that undervaluation metric in terms of the silver. That is why we're still bullish on silver. And there's a lot more room for it to outperform gold and have that ratio come back further.
Sure, and I definitely want to encourage our listeners and clients, be cautious of this parabolic type of move.
Always.
And be cautious of, like I said, with gold, we've come into the low end of those 2013 highs. We're at the bottom of the candle. Those do seem to be good turnaround points. There's a reason why I like them, is you tend to see those as turnaround points. They don't come up to the exact high. They find somewhere in the middle or the bottom. So with gold, having such strong RSI divergence after such a big move up. Same with silver. We've been talking correction for a while. You know it's going to happen eventually. I could be wrong for 3 more months and maybe silver's $40 before it happens, but just be aware that these things do happen.
Let me tell you another thing, and maybe this is for the land of ETFs. You know, we deal strictly in the physical precious metals, stored or possessed bars, coins, what have you, IRA metals. ETFs, you have a little bit different phenomenon. We are so far detached from the 50-day and 200-day moving average in silver that to me this is a sell signal. And I wouldn't hesitate to sell here and pause and wait for that pullback. Because how much of a profit do you need in a short period of time percentage-wise? And it needs to, from a healthy standpoint, pull back before we go and set higher highs. And we will set higher highs. Because the fundamentals, which we'll get to towards the end of the show, are all continuing to build. But this divergence that you talk about, the separation for me from the moving averages is so enormous that whenever we see this, ultimately it leads to a pullback to come down and come close to touching those moving averages.
So taking what we've learned about what gold did, what silver is now starting to do, I think it is worth looking at platinum because, as we've said, silver is lagged behind gold. Platinum is also lagging behind silver. So there still remains good opportunity. Even though platinum is, I would argue, at the top of a channel, I'm sorry, I'm a platinum buyer. I don't care where the chart is till platinum's $500, $600, $700 higher.
Yeah, you've been feeling good about platinum for
Right.
a while. I will say that.
So in the short term, you can see in the chart, platinum's been making this kind of compressing pennant upwards. We hit the top of that channel today. Platinum had also a screaming day up. It's at the top of that channel. We think silver's probably putting in, 8-year high at this point. Gold is putting in a 9-year high and right at the bottom of its all-time high. So could we see these metals turn around over the next week? Absolutely. Platinum today is a buy, regardless of $50 up or down, because it's lagging so far behind silver. Okay, I'm talking about these 2013 pricing, right? Platinum at that same time in 2013 was over $1,700. Platinum has $1,000 to go almost just to catch up with what silver did today, what gold did a year ago. So that to me is a screaming deal.
Yeah, we've been saying it's the most undervalued versus gold versus palladium and versus silver than it's ever been. And so you're building potential energy here in platinum.
And then finally, palladium. You know, I was actually looking for palladium a push down, but because of what's going on politically, economically right now, you're seeing all the metals across the board up. Palladium has also turned up and is back slightly over $2,200 an ounce. So because of palladium and platinum both going the same direction, in the same pattern over the last week or two. Ratio hasn't changed too much, but I'd still rather buy platinum for $1,000 than palladium for more than twice that.
And that takes me to the next topic, and that is all of these things sort of moving in concert with each other, to me, reeks of the dollar. So you've seen the dollar roll over, turn down. We talked about that pivotal support point around the 96. It didn't hold. Not only did 96 not hold, we dropped down below the 95. So I'm real excited to get into a little analysis on the US dollar index and explain equities, commodities, everything's going to adjust to a weaker currency. That's what inflation is. So even the stock market's going to adjust upwards in terms of revaluing each share for a weaker currency. Metals do the same thing. They just do it at a faster pace, a more aggressive level. So show us the dollar.
Sure. Well, it's what we pointed out a couple weeks ago, right, where we overlaid the Dow to the dollar, and we said the last time the Dow was at this price, the dollar was at a much stronger level. So it's taken a loss of purchasing power globally just to force the Dow back up to pricing it was prior to the March fall. So it has cost us something. You see the Dow pushing back up to 27,000, you don't own as much. It doesn't buy you as much. And now the dollar's falling even more. We're almost at the lowest price of the year. I think that's not too far away. Maybe in the next week we get below that. That's the lowest price in the last 2 years. We get below that pricing, and now we're looking at the dollar going back to like some 2014, 2015 levels following the last real estate crisis and stock market crash.
It's coming. We're going to see the 80s. We said that last week.
So now we're into the mid-80s.
Yep.
And that can all happen in the next 6 months very easily. So what is it going to take to get the stock market back up? And that seems to be the question. Are we willing to give up 5, 10, 15, 20% purchasing power at the grocery store and the gas station just to push our 401ks back up, arguably, to the old highs.
Well, we do need to point out that the NASDAQ just hit a new high, and that to me, we know is not a healthy, viable market. Yes, it's adjusting to the dollar, but long before that, you've got central bank intervention, you've got sovereign nations buying equities, and you've got the federal government printing $4.5 trillion and injecting it into the system, mostly into the markets as well. So be careful about chasing those high highs, just like I'm saying, be careful about chasing an 18% 1 week performance in silver. It's going to continue. We'll see the ratio correct. Someday the equities markets rally will resume, and we'll be talking about a 40,000 point Dow. I have no doubt about that. But from where will it resume? We're not done putting in the lows.
Yeah, my question stands.
That's right.
Like, what's it going to cost us to get there? So sure, the NASDAQ is putting in new highs. I would argue the NASDAQ is a much more speculative look at the market than, say, the S&P or the Dow, which are both lagging right now.
I'll tell you what it's going to cost us. It's going to cost Europeans 750 billion euros. That's the stimulus package that they just passed.
Oh, come on. We're printing that like every day, aren't we?
Yeah. Well, that's part of what we've seen here from a cause and effect standpoint. But we're talking about $1 trillion more. It's going to be a very intense political battle, left versus right, Republican versus Democrat issue in terms of where those monies go. The Democrats want to lean back towards like a $3 trillion stimulus. So get ready for more spending. But that's what it's going to cost us. It's already started through the European Central Bank. That's a record stimulus, and unfortunately half of that is for fighting climate. So it's a politically sensitive, or should I say politically correct, motivator that is the ultimate benefactor of that stimulus, which is an indirect economic stimulus, mostly in the forms of grants and loans. Who knows what's going to happen here?
Sure. And what continues to concern me, at least here stateside, is even just in the last week, compare the dollar to the Dow. Robert talked last week about how the S&P was at this breakout point, and the S&P did happen to inch slightly above where it was, but the Dow hasn't, and the transports haven't. So the big name companies are not keeping up with, say, the NASDAQ. So what did it cost? I mean, it's costing Europe, it's costing the U.S. taxpayer, it's costing the U.S. shopper. The guy going to the grocery store is going to see higher pricing on that run. So we've had economic crisis over the last year. Economic crisis. We've had a medical crisis this year. We've had social unrest, social crisis, and now we're moving into election season, so here comes the political unrest.
This is fascinating that you just said this, because I would have forgotten to mention this, Miles, but I had an outside broker relationship. This gentleman talked to me. He said, this is the first time since 1900 that we've had 4 major disruptors in the same year. All right, 3 times since 1900, we've had 3 in the same year. Okay, those 3 were pandemic, mass riots, and very pivotal, tense, politically divisive election cycle. That's happened 3 times. And when you have 3 major disruptors, a disruptor is a disruption of the economy and certainly creating a social unrest and tension. 2020 is the first time we've ever had 4. So add recession to those 3.
Right. We forget that this all started there, too.
And it did, right? It's stimulated by a pandemic. So you've got a pandemic, you've got a recession, depression, you've got an intensely divisive political situation going on, and you've got mass riots. So those 4 together and no end in sight, it's not like we've hit the bottom in any of this. It's not like we've fixed anything. It's not like we can say, okay, we've had a bounce point. And here we go, things are going to get fixed, and it gets better from here. No, we're 3.5 months away from this election cycle. We still have protests and riots. And wait till you see what happens after the election. And then the pandemic shows no signs of really slowing, and the recession's deepening and turning into a depression. So we're not done yet. So of course in your portfolio you're going to diversify into gold and silver, because of course your portfolio is going to witness an increase in the gold and silver price as a result of this. Silver is finally pricing in inflation. It has yet to really even be priced into our pocketbooks, to your point. But I'm telling you, you're absolutely crazy if you don't buy as much as you can on any dip from here.
And who would have thought that the straw that might break the camel's back Is the U.S. running out of quarters?
Yeah, well, it's a good point. I'm glad you brought up the fact that a lot of stores, a lot of independent businesses are refusing cash. And it's not just because of a national change shortage. This is an agenda that's being pushed through. So if you want your privacy to remain, that's another reason to be taking possession of gold and silver, because I'm telling you, they're going to force everybody into the world of banking, credit card transactions, and digital currency.
Well, and to me, that's just a powerful argument as to why investing in GLD and SLV today, because the price is going up, is one thing, but actually taking some tangible ownership and giving yourself a little bit of autonomy in a system that is pushing further and further and further towards control and tightening down the clamps.
Centralization,
not just of our political authority, but centralization of our economic autonomy. Having a little bit of something that you can carry around in your pocket, it's hard to argue with.
That's right. Well, with that, we're going to wrap up this week's Golden Rule Radio. Again, it's been a very pivotal show, and it's been quite an exciting week. We'll see what the next week brings. We really encourage you to send us your comments, your feedback, and sorry we didn't get to any listener questions, but we read them, we hear them, and keep them coming.
As always, if you liked what you heard, hit the subscribe button, ring the bell, join us in the comments if you have any questions. You can head over to our website at McAlvany.com. You can find us on Twitter at ICA Gold or Facebook at McAlvany Financial. And if you'd like to speak with Tori, myself, or one of the advisors here at McAlvany ICA to discuss your personal precious metals portfolio, feel free to give us a call anytime at 1-800-525-9556.
Thanks again for listening. Have a great week.